Good afternoon, and thank you for joining us for today's roundtable on private equity exit strategies. I'm Matt Porzio with Intralinks, and I'll be moderating today's discussion as we explore topics including which sectors are poised to see the most private equity exits, who will be more active in acquiring portfolio companies, financial sponsors, or strategic buyers, and what are the expectations for distressed exits, IPOs, and dividend recaps. Joining us today are Gerald Parsky, Chairman of Aurora Capital Group, JP Paquin, Managing Director at Brown Brothers Harriman, and David Solomon, CEO of Lazard Middle Market. Throughout the program, you can ask questions via the live chat feature, but we've got a lot to get through, so let's get started, gentlemen. Jerry, I'll ask you the first question.
Okay.
Some mixed reports on what we saw in terms of private equity activity and exits in 2013. US being down, globally the market being up. What do you think drove that? And more importantly, what is your outlook for 2014 for the rest of this year?
Well, I think overall 2013 was a very strong year for exits. In part, those private equity firms that were able to grow solid businesses and put them up for sale, they would have received a natural response. But the credit markets were extremely strong. And when you have a credit environment like we had in 13 and to some extent in 14, a number of buyers who were willing to borrow low-cost debt, that drives the exit market to levels that haven't really been seen before.
And do you think that'll continue?
Well, the credit markets have not cooled down. I think a number of very solid businesses were sold in 2013. And so as long as the quality of the business remains, the credit markets still offer strong opportunities to those private equity firms that are willing to borrow. I mean, there was debt available at 7.5 times EBITDA. Our firm is quite conservative on how much we will borrow. And so we weren't active buyers, although we did buy, but we weren't active. We turned down a lot of transactions. But there are different ways to look at the buying market. I think the companies we sold were purchased, and the people that purchased them will do very well with them.
And JP, do you have a similar outlook?
I agree. It doesn't hurt that the public markets continue to do well as well on the equity side. But I think when you've had a period where there was sort of earnings growth that went through the post-recession period that was not very strong, and now that's started to become more robust again, I think people definitely have been active, and I see that continuing in 2014.
Yeah. And David, similar perspective?
Well, I think you also need to look at a little bit further back in time when, because of capital gains change, there was a huge rush for the exits in 2012. Right. And people trying to capture that if they were going to sell and exit anywhere in that time frame, even early 2013, they'd accelerated it into 12. And I think that left a little bit of a vacancy in the first half of 13. And we've seen, obviously, an increase in transaction flow later in 13. But now, as everybody has said, I think that the conditions are ripe for a more normal M&A market.
Yeah, and we've talked about the overhang issue. What is your view on that in terms of, many of these portfolio companies have been on the books for quite some time within private equity firms. What is the situation there, and what do you think we'll see from the market?
Well, this is a very interesting phenomenon, and I think we could have a little dialogue on this. There's about 7,600 portfolio companies in private equity hands, according to PitchBook. And of those, 4,000 were acquired before 2009. So there is about 53% of all portfolio companies are older than 5 years. And that's the typical, the hold period. So that suggests that there is going to be some movement of taking those 4,000 or some portion of them to market, over the next few years. And if you, look at, even half of those coming to market, that could add a significant amount, 20 to 30 or even 50% to the deal flow in any given year. as we move forward in the next few years.
You know, a lot of people think about private equity as a 10-year product because that's the stated initial term of a private equity fund. But in reality, it often takes 11 or 12 or 13 years to exit a portfolio completely. And I think just to Dave's point, the inventory that's out there that is older than 5 years tends to be in funds that are now getting to that 10, 11, 12-year sort of age. And I think there is pressure that limited partners start to put on investors to make sure that they're getting those funds to liquidity, and that will, you know, ultimately drive people to push things into the market as well.
Yeah,
I
Jared,
think-
you have some great perspective from the LP view as well.
Well, yeah, I did have the benefit of working closely with the University of California as a regent and as chairman of the investment committee. I think that the overhang issue needs to be, you need to separate a little bit the categories of companies that may be available. And 5 years is an average hold that many private equity firms use in indicating to investors what the hold period might be. But, and I do think there are a lot of companies that are there, but some companies, private equity firms may have wanted to change strategy for. So they maybe have held it for 5 years, but after 3 or 4 years, they decided that there were some changes that needed to be made. And they still can produce solid returns, especially solid multiples of invested dollars for their investors. So I would separate those. There may be some that are troubled and need to be, you know, totally turned around. But I do think that there will be quality companies given the period that'll be available. You just have to make sure you can assess, if you're a private equity firm buying from another private equity firm, what's the growth path for this company going forward.
And Matt, you know, one of the things that I think also needs to be articulated is why is there this overhang? And it really does relate to the financial crisis. You had companies that maybe had 30 million of EBITDA, went through the crisis, their EBITDA went down 5 or 10 million. Now it's beginning to come back, and there is you know, the whole thesis of when you exit, I think, is complicated by returns on capital. Are you looking for multiples? Are you looking for IRR? But whatever you're looking for, getting back to even isn't enough. You've still got to have a preferred return going to your limiteds. You're still thinking a little bit about option value. If I hold on to this company a little bit more, I can go from 30 to 35. Maybe with a little luck, I can exit this with actually a more normal or normalized return, even despite this long hold.
I think IRRs are important. I have kind of a somewhat funny comment, though. I say to a lot of our people at Aurora, you can't eat IRR. And multiple of invested dollars, assuming you have a competitive IRR attached to it, is a real focus for us, and I think for a lot of private equity firms today.
And JP, I mean, doesn't it matter sort of where you are in the overall cycle, right? I mean, if you're raising new funds and you have some portfolio assets that are kind of tough to move on from in existing funds, that makes it more challenging.
Absolutely. I mean, we went through a period of time after the recession where it was very challenging to raise a new fund. And so if you were in the fund manager business and you were trying to raise a fund, you know, and you hadn't had the exits that you wanted to have in 2008 or 2009 because the market was not really ripe for exits at that time, certainly you were not necessarily positioned as well as you wanted to be for the fundraising effort that you were going through. I think as we've progressed and now we've had a couple of fundraising years that have kind of been more solid, and people are starting to put their new funds together and are looking forward. More often now they might be looking back and saying, okay, why don't I settle up the score on some of these older funds? I have you know, a new fund that I need to deploy, and why don't I turn my focus to that? I think it's really important. I don't want to suggest that people aren't being disciplined in when they sell some of those older companies, but I do think that we talk about sometimes the option value that might be in people's heads around companies. A new fund is now that representation of the option value that might be there going forward, and people are turning towards that.
Yeah, that's a great point. I mean, we also talked, JP, about the process itself. You don't wake up one morning and say, let's exit,
Right.
and
Right.
it happens tomorrow, right?
Right.
So in terms of that, and Jerry, you too, thinking about the process as a whole, from making the investment decisions to managing portfolio companies to eventually exit, have things started to change in the marketplace? Is it done the way it was historically, maybe even before the crisis, or are things different now?
Well, I'd say that at least from our perspective, when we analyze whether we should buy a company, we try to put together our view of where that company can go, what its growth path would be, revenues and EBITDA-wise, and what our objectives are for the business. And we continually reevaluate that on a year-to-year basis, and we have what we call internally a buy or sell process. Would we buy the business at the point at which it's at, or would we sell it? And we try to rigorously go through that. Now, we don't do that within our private equity fund in the first few years. But once you've held a business for 2 or 3 years, that kind of analysis done every 6 months is, I think, worth doing. The other element, I think, that has to come into play, especially in some of the industries, is do you have an acquisition strategy to add on investments, perhaps in most cases at a lower multiple than you acquired because they're much smaller businesses. And if that acquisition strategy still has a lot of room to grow, that will impact things. You want to make sure, though, that when you think about exit, you're in a position where you can say to the next buyer, whether that buyer be a strategic or another PE firm, there's plenty of growth opportunities in this high-quality business that you're selling.
That's the key, right? JP?
When you're in the private equity business, you have to drive your companies towards exits, right? And so on the buy side, as Jerry said, before we make an investment, we're thinking about where do we want to go with that business and how are we going to help it get there. When you go to sell a company, as Dave will no doubt confirm, if you have multiple buyers at a table, that's going to be a much better scenario. So we're in the private equity business. Private equity investors like to buy companies. You can always go to the private equity markets and hope that they'll be receptive to your companies. But you also want to try to make your companies attractive to strategic acquirers. As you work with your businesses over time, trying to make sure that you're positioning them to have that optionality at the end is really important. And one of the things that certainly is critical to all of that is management. I think that we are not operators of businesses ourselves. We have operating partners that assist us in overseeing our businesses, but at the end of the day, we're relying on a CEO and his or her team to run our businesses for us. We need to make sure we're in tune with what those executives want to do on exit. And that's a discussion that starts right at the beginning, but then continues throughout the life of an investment. And I think it's a really important thing to know, because when you get to the end of your period of time where you're now really going to take a company to market, you need to know, are they going to be supportive of re-upping with another private equity investor? Would they prefer to sell to a strategic? Do they absolutely not want to sell to a strategic because they feel like that would impact the culture of a business that they've built over many years? These are all things you need to be thinking about. And I know we will be talking maybe a little bit later today about the IPO world and how that's impacting our business. But now if you start talking about taking a company public, you need to start evaluating your management teams in terms of whether they can be a public company management team from a CEO and CFO perspective too. So there's a lot that goes into the planning for an exit.
Yeah. And eventually you turn to David as the advisor to run the process.
We wouldn't look to anyone else.
Thank you. But at Lazard, our job is to run a great sell-side process where we're thoughtful about the growth, the team, all of the fundamentals. I think it really does come down to fundamentals of the business and bringing to life what what are the sometimes the hidden gems and the positioning of the business that is really going to make it sing, both for private equity acquirers or strategic. There are more financial buyers acquiring companies from other financial buyers today than ever before. There's been a long-term secular trend in that direction. Today we're positioned, and you see in the market, strategic buyers with plenty of cash, plenty of currency, renewed optimism, a slow growth environment, that perhaps acquisitions are the best way to grow. And so we have a lot of conditions for both private equity and strategic buyers to be very, very active.
One thing I'd like to mention is when you start talking about sponsor-to-sponsor sales, oftentimes people think about that from the buy side and say, what am I missing? I'm buying an asset that some other professional investor should have maximized the value on, those types of things.
Yeah.
I disagree with that entirely. I think that you do need to recognize that these companies hopefully have been well managed by your predecessor, and you're probably going to pay a pretty full price when you buy those businesses. But that doesn't mean that you can't have a strategy for what you want to do with that business going forward. It doesn't mean that you can't turn that in and of itself into a success. We bring, as private equity investors, an urgency to our businesses. And I think when we have successes, it's easy to get comfortable and to lose a little bit of that urgency as you near the point of exit. And from a company's perspective, to reset that urgency clock can actually be pretty interesting. A long time ago, because it takes a while to see this play out, but in the late 1990s, I sold a business that was it was a 3x return for us. We sold it to another private equity investor. That private equity investor made a 3x return, subsequently sold it to another private equity investor who also made a 3x return. So it's been a phenomenal story, and the company is way different than it was when we were owners of the business. I like to think maybe I could have gotten it there, but I'm really not sure. I think we would have probably lost that urgency, and it was a great thing for the company and its management team.
I'd make 2 or 3 comments.
Yeah.
One, I totally agree with the importance of assessment of management. The critical decisions for private equity firms are who you're going to partner with in terms of management. And if you have the benefit of some experienced executives on your board or in your advisory group, as we do, it helps evaluate both going in and on an ongoing basis. We happen to have, as chairman of our board, Larry Bossidy, well-known executive, been a terrific help to me and to all of us at Aurora. And he helps us to continuously evaluate the performance of managers. And if they get through his mantle, they might be quite ready for Honeywell or GE or someone else to buy. But the assessment of management going in and on an ongoing basis is extremely important. I totally agree. If you're thinking of an IPO, and we'll talk a little bit about that, maybe a little different mentality to have to deal with analysts or Jim Cramer regularly. But
It's right across the hall.
well, we can bring him in anytime we want. So that's the first comment. The second comment is I think this environment does offer strategics an opportunity to look at buying businesses. But I differentiate a little bit how a strategic might look at a given business and how a private equity firm might look, and the marketplace that we were talking about before. When you have credit available at this level, relatively inexpensively, private equity firms will be willing to acquire at a reasonable price. To some extent, the strategic looks at the potential synergies that may exist between the asset they're looking at buying and their own firm. And the credit markets are less important, but the synergies are critical. So if they can see those synergies being realized, especially in the first year, then you'll see strategics willing to pay significantly higher prices in that. But the third comment I'd make, and I totally agree with what has been said, I think that one of the most important things is Do you have a business at a given point in time that is ready to grow the next wave? The idea of having a business that you could earn 3 times and then 3 times is a terrific example. To some extent, it brings out the fact that, in one sense, I wish the private equity firm could have held the business and grown the business for all 9 times.
Right.
But that's not the nature of the PE firm.
And that's, that's something I wanted to, both Jerry and JP, what's interesting about what you're talking about is you're somewhat in a box by the private equity structure. So you have a 5-year hold or a planned 5-year hold. You better do a lot of your heavy lifting in that first 1 or 2 years because you're trying to reap that at the end of the 5-year period, right? And on the other hand, are you going to undertake a big, risky project in year 4 or year 5? Probably not. Right. You're not going to see the return. So it does, just the cycle of private equity takes away the urgency because you've got to do it in year 1, 2, or 3, or you're probably going to defer.
Although tell me if you agree with this, I think we're at an interesting point in the market right now where companies, even in that 4th or 5th year of ownership, are making acquisitions, and then they're immediately going to market, and they're almost setting the stage for another buyer to inherit, a company that still actually has a fair amount of execution risk associated with integrating businesses and making that thesis come through, but they're able to sell it in this type of market on a bit of a pro forma basis.
Yes,
and,
we find ourselves in that situation, but it's a bit of a Hail Mary pass, I think.
I think you're right, and I do think the structure of the private equity partnerships is a deterrent to holding on to businesses that you can still grow significantly, given the pressure to exit. And we try to educate at least our investors to say to them, we are here to generate a strong return and a strong multiple of invested dollars. And although the average may be 5 years, we're not afraid to hold on a little longer. In one sense, I wish the model would allow us to accumulate businesses that we really think. We sold 3 businesses last year out of 1 fund at very, very strong multiples and very strong IRRs, and I wish we could have held the businesses for the long term. In one sense, I wish the private equity model would allow us to create a middle market Warren Buffett strategy where you can acquire and hold for the longer term.
That's a great point. Jerry, there's actually a question for you from our audience already. So,
do you want to screen the question to make sure it's easier? Or?
I think it's related to what we've been talking about, but maybe a little more detailed. So when you decide to engage in an exit process for one of your portfolio companies, have you changed or altered any exit strategies that create value add during that process to create extra value? I mean, that's sort of what we were getting at, but how do you actually do that or change the process to do that?
Well, apart from the fact that we only hire Lazard to help us, we'll put that aside for a moment. What we try to step back and say, what's the most important thing in the exit process in today's world, and that's competitive tension. You need to have a quality asset at the right point in time to sell, but the buyer universe, there needs to be tension around. Yeah. If you're in a situation where someone wants a one-off situation, that's a little bit dangerous to be able to achieve for your investors the best price. So it's one of the reasons that we do, in most instances, hire a banker to assist us in that process because of this competitive tension. Then the second thing is that tension only among private equity firms, or is it an asset that a strategic buyer may, and that takes a little bit more analysis. Final point I make is that, and I think it was brought up a little bit before, and that was, you want to be sure in the 4th or 5th year that you don't do something just because you're thinking of exit that will in effect, not maximize the value. So for instance, if we saw in our 4th year of hold, as we did with one of our companies, a really quality acquisition, and the comment was made, well, you might not be able to integrate that. We looked at that situation and we decided not to exit until we could demonstrate there was a level of integration that proved the point. So assessing where the company is, making sure that you've got the right tension among the buyer universe, and we give a veto to our management. We say to management, look, on the margin, we will have several buyers here. You're going to be interviewed by all these buyers. If we want to have the best program going forward, our best references are the managers that we have backed. And exit process is extremely important, obviously, to us and the managers. So we have said to our managers, on the margin, you tell us who you'd like to be with. And in a couple of instances, and we explained this fully to our LPs, we took a little less value because it was really important to the manager. And we explained it. We went to all of our LPs and we said, in this instance, we're going to take a little bit less for this reason, and it was a tremendous return. So the LP said, that's your call.
One of the other things, I agree with a lot of what Jerry said, one of the other things that we work with our companies on is the same way we came in as buyers and needed to see a 5-year plan for the business and to stand behind how we were going to grow a company after we invest in it. We know we need to present that as well to a future buyer. So in the later stage of an investment, certainly we're spending a lot of time trying to make sure that we are investing in the business in the right ways to make sure that the foundation is there to support an ongoing growth story and that we can articulate that growth story well when we go to market. And certainly David and others like David help us do that, but internally we want to make sure that that we buy those growth initiatives the same way we're asking somebody else to buy those growth initiatives.
And that's
a
work
very
up
good
front gives David a head start for exiting or helping you exit. So David, I want to start with you in terms of where are we seeing the activity and where is it going to heat up in terms of sectors? Anything in particular, and then also maybe some segmentation filtered in there as well. Is it going to be large deals in a certain sector? What's your view there?
So let's thinking about this on a high level first. I would say that it's quality of earnings and growth are really going to drive interest in an asset. So in certain sectors of healthcare, for example, there's a lot of growth, there's a lot of consistency, there's a lot of interest, both strategic and financial. In other areas of healthcare, there's Medicare reimbursement risk, questions about the regulatory environment, and those are more problematic. And I think you have to actually parse through each sector like that. So another example, retail. Bricks and mortar is losing market share to e-commerce. We're finding in our e-commerce business, it's booming. There's a big shift going on to both digital, catalog, and multi-channel or omni-channel. Those who really don't get that, there's a lot of bricks and mortar retailers who are are shrinking. So I think you again look at it now. The sectors where there's a lot of change and growth would be technology, healthcare, certain industrial areas, engineered industrial where technology is being applied. Tech-enabled business services are very hot because here, using technology, you're doing something for less than what companies typically could do in the past, and so they're outsourcing. This whole outsourcing trend, I think it really does follow technological change and systems change, and there are secular trends in various of these different sectors where you're going to see that growth.
I totally agree, and on the sectors, I think you're right. We've seen having gone through a recession the way we went through, I think that, people are very focused on how sustainable are top line revenues, how sustainable are earnings. And as you start to think about where do you find businesses with recurring revenue streams? Where do you find businesses where, the profit structure is such that you can also then expect recurring profit streams? I think that companies like SaaS type businesses on the tech-enabled services side clearly fit that definition very well. In healthcare, there's been a lot of change in the healthcare markets over the last 5 or so years, but clearly healthcare cost containment is a major issue, and people are very focused on that. If you can marry healthcare cost containment with some type of SaaS revenue model, even better. It's great. And just one of the examples Dave mentioned too on the movement from bricks and mortars to more e-commerce, that's now opening up a world of logistics for actually serving these e-commerce companies and getting product to customers who are buying over the internet that we found to be pretty interesting too. So.
I think I certainly agree with what's been said. I would also add that as we look at a particular business, we also try to step back and look at the structure of the industry at a given point in time. If an industry, if we're troubled about the structure of an industry, the airlines industry, we would hesitate to make an investment even though people have made money in that industry. Similarly, if an industry, I have way back an experience of being in the United States government. If the United States government or any government entity has a big regulatory say in an industry or particularly where a company may be, it's not that you wouldn't invest, but you have to build it into the risk factors. We believe very strongly in looking at things, returns and otherwise, on a risk-adjusted basis. So understanding the structure of a given industry, where an asset fits, I think is really important. And I'm not quite sure I would say, one industry is hot over another, but I would say this, that multiples, the willingness to pay a higher multiple comes with the level of risk that may exist. So if you have a well-structured industry, you have a business that has been growing and especially grew in 2009 and 10, in today's environment, you really can see a path. Then you're willing to pay a higher multiple. Often, investors will ask us, "Well, what's the multiple you would pay?" And at least from my perspective, I don't think there's a set answer. You can pay to some businesses. You would only be willing to pay 8. We've paid 10 times. We bought a company for 10 times and we sold it for 10 times, but we grew the business significantly and it produced a very good return.
And that's a great transition to the question of valuation, right? In an industry or a sector that's showing positive trends, we mentioned some just now. Are the valuations, are we reaching a peak in some of those industries? Where do we think valuations might go from there? JP, if you want to look.
I think valuations are pretty high. I mean, Jerry in some of his opening comments was commenting on some of the factors that are driving that in terms of the availability of leverage and the like. I do think I would rather pay a full price for a really high quality business than pay an average price for a low quality business. So, in a market like this, though, you have to be aware of a rising tide lifts all ships type of phenomenon. And we're very focused on what are the assets that we're purchasing. How do we think we can grow those businesses to get the types of returns that we're trying to generate for our investors? We are walking away from an awful lot of situations that price is just running away. Businesses that, in our market, we're sort of in the lower end of the middle market. In our market, that might have traded at 5 or 6 or 7 times are now trading at 7, 8, or 9 times. we're very cautious about those types of situations.
Yeah, Dave.
So, and what's causing all this? So you've got too much money chasing too few deals at the moment. That would be my prognosis. You've got $465 billion of dry powder on the sidelines. There's a use it or lose it phenomenon. Number two, the available pool of sellers is not as large as it was back in 06, 07. And so you have scarcity value. And you put that together with strong credit markets, and people are going to put the money to work and pay high prices. According to PitchBook, in 2013, we were probably the second highest level of median multiples since the 06, 07, 08 timeframe. So we're really at historically high levels as a result.
Yeah. In terms of, the potential for that valuation gap, I think that we've indicated. I mean, David, are you seeing and are you employing different strategies to try to bridge that? I think we talked about the synergies that a strategic could realize. How real is that? And are strategics coming back to the table and being a more viable option to get that right valuation for your seller?
Well, so we don't see a valuation gap, but by definition, you run a process, you find out the current market value of the company, and we're, as a seller's agent, in most of our transactions, we're thrilled to get big multiples. And but where is this going is the question, and is this going to create an imbalance? E&Y just did a recent survey of M&A professionals, and their projection is, in fact, that multiples will continue to increase a little bit going into 14. But strategics are sitting there with a lot of cash. As Jerry said, if they have synergies, they're going to play and be competitive with private equity. On the other hand, credit markets are going to probably stay open, and they're very strong right now. With all the cash on the sidelines, we have plenty of buying capacity, both from strategic and the financial side.
I think I agree with that. I think there are caution flags that exist on the credit side, not necessarily in the short term, but having had some level of experience from the Treasury Department, about every 6 or 7 years, there's a dislocation in the credit markets for different reasons. Right. And there is a real difference between what exists out today and what existed in 2006. And we were faced, obviously, with a big housing crisis and a financial crisis and a business downturn altogether. Nevertheless, there are some signs that the business cycle will come back. But more importantly, that interest rates will move upward. Now, I can't predict and wouldn't try whether or not to extrapolate the Fed's comment about 2015 as there or not. But at some point over the next 18 months, it's going to be different. And that would signal to some extent caution about the leverage. It may impact values that are achieved, not necessarily what a company may be worth, but what would be achieved here. But I think in the short term, potentially over the next 6 to 9 months, there should be a continuation of values, provided you have a really good company. A lot of very good companies were sold last year. Yeah. And I think we have the statistics here about the number of exits last year, and they were the highest. The other thing, only other comment I would make is in the space that Aurora is involved in, which is middle market or lower middle market, companies with enterprise values between 150 million and $1 billion, with really zeroing in on 300 to 500 million enterprise value we buy. If you look at the differential in margins between the larger companies that are run in a quality way, EBITDA margins, and those in this space, there's a wide disparity, which we view as an opportunity. If you can bring resources, operating people, I mentioned Larry Bossidy. We have a whole array, as do other firms. And if you can effectively bring operating improvements to smaller companies, many of those companies have not learned Six Sigma or lean manufacturing or other things that are touchwords with GE and others. If you can bring those to bear on smaller companies, you can see a significant operating improvements, which will make them attractive exits.
You know, what's interesting is I think we all, globally, exit volume was high and transaction volume was very high last year. In the U.S., it actually was not a great year. It was down a little bit from 2012. And you put that against the backdrop of us saying there's all this capital out there waiting to get invested, and there's a lot of leverage out there available to buy these companies. And we do know purchase price multiples have gone up over time. But I actually do think people are showing some discipline. You know, I think that one of the reasons purchase prices are up is because they're buying better businesses. I think that any of us who lived through the global recession need to be very aware, as Jerry said, there's some parallels to what we're seeing today when you look at the broad trends in the statistics. And we don't want to get into a situation, leverage is great when it works, but when you go through a cycle where you have a 25% contraction in enterprise value multiples, suddenly it hurts a lot. And so I do think people are remembering that, and we have seen situations where companies that weren't as high quality tried to take advantage of this market and they weren't able to get sold for those crazy prices or get sold at all. So, you know, from an industry perspective, I hope people have learned that lesson and they'll continue to, but you never know. It's definitely pretty buoyant out there.
Although we're also seeing, I mean, and David, you can touch on this as well, is the IPO market to a certain extent is another alternative that is growing in terms of what we're seeing in terms of exits.
Yeah, so IPO has always been around as an exit vehicle, but it's always been a very small component. And if you look back over the last 10 years, it's maybe roughly 10% of all exits. It grew a little bit last year. 2013 was a great year. People taking a restaurant public, for example. But the dilemma for a private equity group to exit through IPO is that it may look good for year one or year two, and you've sold down some of your secondary shares, which is the shares owned by the fund. But you're not out entirely. You may discover that you still have a small cap or micro cap, illiquid stock. The stock moves down, and you're stuck in the stock for a long period of time. So I think it has higher risk unless you get to either consistently high growth or much higher enterprise values to begin with to ensure that you can survive the period of the follow-on after follow-on to fully exit.
I think the IPO market is limited for smaller private equity firms like ours. First of all, I think the comment was made that you really have to assess the executive that you're backing and the team, and are they prepared to be executives of a public company. That takes a different skill set at times, especially with the analysts and worrying about Kramer. Put that aside, I do think that in the exit process, I think one of the questions was how do you get ready for an exit, or what do you do? If you have a company that has an enterprise value of $200 or $300 million, I think it's somewhat risky, the way David was saying, to try to take a company of that size public. It can happen. But if you have a company you've grown that potentially has an enterprise value of $1 billion or more, even if you bought it for $200 or $300 million or in that range, it is a potential IPO. Sometimes it is effective to utilize what I'd refer to as the dual track approach to exiting, where you file, and we did that with one of the companies we sold last year, where you file, and it could have been, in fact it was when we bought it, but we took it private, but then we filed a registration statement, and it was kind of a signal to some that the company was obviously for sale. And we still hired a Lazard-type person to help us, but that aside, it ended up where it was acquired in whole. So the IPO possibility was helpful in the exit process.
JP, do you think in this market that also sector might play into it?
It does. There are definitely some sectors that are hotter than others in terms of receptivity in the markets today. Certainly technology, and again, some of the healthcare companies I think have been pretty successful. I think it's the psychological impact. I agree that there's a certain scale that you really should have before you consider the public markets. And like Jerry, we are, we're a lower middle market private equity fund, and so our companies that exit, they may be now valued at $200 or $300 or $400 million. There won't be that many that will be appropriate for the public markets. But I have a couple companies in my portfolio today that are now getting regular calls from underwriters, and they're whispering numbers into my management team's ears and into our ears. And it's hard to completely discard those types of conversations. We have generally taken the mentality, let's just keep our heads down and keep working with these businesses and drive along the lines that we were already working. But it's definitely out there. It's definitely out there.
And there's other challenges with being a public company.
There is. Dealing with analysts on a quarterly basis is a challenge in and of itself. And to some extent, some people feel that you don't have the flexibility in terms of some strategic moves you can make because it's continuously driven for increasing earnings there. And if you're a private company, if we, for instance, see that a significant acquisition would really help the company over a 2 or 3 year period as opposed to in the first year or the first quarter, we might make that acquisition if we were private. And there may be some hesitation if you were public.
So going back to the concept of the secondary buyout and that increasing in the market, if IPO is not the chosen path or a sale to a strategic, is there anything else in terms of the secondary buyout market right now that you're seeing that is developing or changing or new?
One thing that has happened is as more sponsor-to-sponsor deals are happening, and you think about how leverage plays a role in that, these are often companies that lenders already know. And so when you just talk about the risk of getting a deal done and getting to completion, and you think about lending groups that already know an asset, they already know a management team, they know that management team can operate with a leveraged balance sheet. That fact pattern is very helpful. You also have in the leverage markets the companies that a lot of these lenders knew that had relatively higher cost debt 3 or 4 years ago, that's all been refinanced out today. So the supply-demand imbalance on these things is changing, and I think that is part of what's fueling sort of the success of some of the sponsor-to-sponsor transactions.
We've found also over the years there's been a change in the landscape of private equity firms in terms of size. When we got started back in 1990, there weren't that many firms that were in the 10 billion range. But it's an interesting phenomenon for us as we look at exiting businesses. Because, and it's not that it has to be this way, but if we can buy a business enterprise value of $300 or $400 million and grow it over a 3, 4, 5, 6 year period so that its growth in EBITDA would justify a $1 billion valuation on the same multiple that we bought it, and it had a growth path. The large private equity firms, all of whom I think are great, but we know several of them very, very well, very high quality people, And we sold two of our businesses to larger private equity firms last year. If it's $1 billion enterprise business, and a firm will want to write an equity check of 3, 4, or even 500 million, that's a very good sized check for the larger private equity firms. So we try to stay very well aware of these firms, and we know the executives in these firms. They're very high quality, and many of them have a somewhat similar approach to companies at the billion range that we have at companies at the 200 or 300 million. They want to see how further operating improvements can be made, what acquisitions can be made. So in one sense, your word secondary sales or PE firm to PE firm can be a positive, not necessarily a negative.
That's right. David?
And Jerry, to just build on that, we didn't really talk yet about the stratification by size within the world of exits. So about a third of all exits, say in a typical year, 600 or 700 transactions occur, about 30% of those are below 100 million, and that's what we might call, either below middle market. We kind of use 100 million as the benchmark for middle market to about $1 billion. So about 30% are below 100. About 50 to 60% are between 100 and $1 billion, and then maybe 10 to 15%, given whatever, depending on the year, are north of $1 billion. And Jerry, your point is that there's a migration through this stratification, and you'll have smaller funds taking somebody from maybe 50 to 100, and there in fact are some increments where it's very interesting. We've seen multiple arbitrage occur at these quantum steps, going from below, from a 50 million size enterprise value company, and you sell it for 150, you get some multiple arbitrage, multiple expansion as you move into the higher stratification, and that often happens when you go from 400 million up to $1 billion.
That's true.
There's actually an audience question related to the PE to PE sale. Is there a rule of thumb on the percentage return you expect in order to acquire a business? So if you're the next level up, right, is there a rule of thumb?
Well, I think, first of all, I really believe very strongly that returns in the marketplace, but certainly returns for private equity firms, need to be looked at on a risk-adjusted basis. That's one of the hardest things to assess from an investor or LP's standpoint. I had somewhat experience with that at the University of California, and I think that's very important. There are different ways to measure risk. If, for instance, our firm has never wanted to borrow a lot of money as we acquire, so our average debt equity ratio is 1-to-1, 40 to 50% equity in every deal. That's one way to measure risk, and it will result in return expectations that should be at different levels. It's not the only element of risk. We talked a little bit more before about the nature of the industry, how it is structured. Are you buying a business that's subject to cyclical risk? All of that should be measured. But in terms of what your expectations are, we're in the business of being an alternative for investors to public equity. So step one, it seems to me, is to say, what are your expectations for your public equity portfolio? And I think, although the last 2 years may be dramatically different, over a 25-year period, if you can achieve in a diversified public equity portfolio 7 or 7.5% returns, those are solid returns. So as an alternative in a portfolio, you want to be able to achieve a multiple of that. 500 basis points, 600 basis points over that same period. That's one way in which I think you can measure. But I come back to another comment I made, and that was multiple of invested dollars are very important in this equation. So we try to achieve north of a 2 times multiple of invested dollars, and somewhere between 16, 17, and 20% net returns over a period on a risk-adjusted basis, and hopefully in a given 5-year period, we can be competitive to our peers.
JP, similar?
We're very similar. I mean, one thing that's clearly happened over time is that overall return expectations have come down from our investors. Our limited partners have gotten used to the fact that there was, as borrowing rates have come down, as high yield and mezzanine rates have come down, so too now have equity returns. They can still outperform public markets, we think, and Jerry sort of quantified that, but people have gotten more realistic. I think I completely agree with the risk-adjusted perspective. At BBH Capital Partners, we have the ability to be both control and minority investors in businesses. We're mostly equity investors, but we can also be debt investors at times. And that flexibility, the reason we've asked for that is so that we can really have a high degree of confidence in the businesses that we're investing in. And so we really expect every company we invest in, and it'll be a small number of businesses, to perform, have that high level of conviction. We're willing to give up a little bit of the upside to make sure that we protect the downside.
Great. David, a quick question for you on, as another alternative, yet another, to sort of return some capital in these investments is the dividend recap. And we see that growing. Can you give us a sense of that environment and why will we continue to see dividend recaps to this extent?
So no discussion of exits could be complete without a discussion of the dividend recap, which beginning in 2003 really took off. I think we saw, according to S&P, about $17 billion of dividend recaps back in 2003. It grew into sort of the mid $50 billion of dividend recaps in the recent history, and in 2013, the stats are $95 billion of dividend recaps. Probably 2/3 loans and 1/3 high yield. And this is a method of taking some equity out, deferring the actual sale, stopping the clock a little bit on internal rate of return, preserving the ability to eke more growth out of this great portfolio company that you have that you're reluctant to sell. As Jerry would say, if I could just hold it maybe 7 years instead of 5 years, and dividend recap is one of those mechanisms for extending that period without taking a big hit on the internal rate of return.
But for quality assets that you believe will continue to grow, right? Is that
Absolutely, and I would also say that as you look at the potential for a dividend recap, you want to assess where it takes your level of debt. Right. So if you bought a business with 5 times or 4.5 times leverage, and you've grown it well over a 2 or 3 year period, you're not ready to exit, but it's ripe for a dividend recap, and you borrow the funds and you are below, no higher than what you were when you acquired it, and you see a growth path, that would make a lot of sense to do at that point in time. But if in order to do a dividend recap, you took leverage from what you thought was appropriate going into a business at 4.5 times up to 6 times, that's a risk profile that I think you ought to have second thoughts about in a dividend recap.
And that leads us sort of to our final question / summation is, do you believe that some of those riskier dividend recaps or some of the multiples being paid today, or some of the history of portfolio companies from that early pre-financial crisis vintage will lead to more distressed activity? Are there some zombie holdings that people just need to exit no matter what?
Well, we at Aurora decided in 2007 that in addition to our traditional private equity fund, we would create a parallel fund with a parallel team. We call it Aurora Resurgence. It's a special situations or distressed fund. We had no idea 2008 was going to happen, but it timed well. But we've created a second fund. That fund did very well. And we established a second fund last year because we do think that there will be opportunities in the distressed area. And so unlike what we were talking about before, where you have in one fund, which I think is a very attractive model, we have two parallel funds, and we can say to investors, we think it'd be appropriate for you to participate in both. But I do think that there will be distressed opportunities coming out of this cycle.
And JP, you feel
I
the same?
think it's bound to happen. I mean, I think we are at a time when people are going to overpay for some businesses and overlever some businesses, and earnings won't live up to expectations that people thought. And it's bound to happen. I certainly hope it won't be nearly as severe as the last go around. I don't think any of us want to go through that again. But, so we'll keep our eyes open.
And David, final thought.
Well, we at Lazard, we have a group that we call Capital Advisory and Restructuring, and there are gradations of distress. Sometimes it's a bankruptcy, it's very serious, the debt has to be negotiated down through some process, some organized, rational process. Other times it's a little bit of it's a slow growth, or maybe it's slightly overlevered, needs some equity. And every situation in these gradations is going to need a little bit special attention. But there will be more, probably, as we've seen. There's always a period of adjustment following some of the high credit situations.
Well, great. Well, thank you, gentlemen, very much for joining us today and for the great insight and lively discussion. And thank you all for watching.
Thank you.
Thank you.
Thank you.